Advanced Audit and Assurance, Chapter 15. Current Issues. Contents: 1. Ethical Issues. 2. The Accountancy and Audit Profession. 3. Transnational Audits. 4. Small Companies. 5. The Impact of Social and Environmental Matters on the Statutory Audit. 6. Social and Environmental Reports and Audits. 7. Exposure Drafts and Other Current Issues. 8. Chapter Review. Introduction. Competences. Legal, regulatory, and ethical issues. Evaluate and communicate the differences between different jurisdictions and how they deal with audit issues, including national approaches, international approaches, and the approaches such as the U.S. Sarbanes-Oxley Act 2002 and related requirements for audit. Planning and undertaking work. Identify and explain appropriate procedures for assurance engagement for corporate social responsibility and sustainability reports. Exam context. As students progress into more senior position within their firms, it becomes even more important for them to keep abreast of current affairs in the audit and assurance industry. This chapter summarizes a number of key current affairs. There is also a section that deals with social and environmental audit and assurance, another growing market for practitioners. By the end of this chapter, students will be able to discuss current affairs impacting the audit and assurance industry, describe the demand for social and environmental reporting, summarize what is involved in a social and environmental audit, explain the current debates and the exposure draft in circulation. Subtopic 1. Ethical Issues. Section Overview. Introduction. Regulation of Auditing, an ethical framework or a rule book. Auditor independence. The provision of non-audit services to audit clients. Auditor rotation. Section 1.1. Introduction. Students need to be aware of current issues in auditing. These issues include ethical issues and the problem of auditing an exemption from audit of small companies. Students should monitor the professional press for further development over the course of their studies. Section 1.2. Regulation of Auditing, an ethical framework or a rule book. There are generally recognized to be two methods of regulating the behavior of individuals. 1. A rule book approach. This sets out the rules about what must and what must not be done. You must not do that. 2. A framework approach. This sets out principles that should govern behavior with reasoned arguments to support the principles. You should understand why it is not acceptable to do that. Both approaches may be enforced by sanctions against individuals who do not comply. There are a number of advantages of adopting a framework approach as opposed to a rule book approach for regulating the behavior of accountants and auditors. 1. It is impossible to develop rules that will deal with all situations. 2. In a rules-based system, the rules may be interpreted too narrowly. If so, the rules cease to be of practical value because they cannot be applied with confidence in practice unless there is a very detailed set of rules. 3. An ethical framework is therefore more flexible. It sets out general principles and requires accountants to apply the general principles to the circumstances of each case that arises. 4. It may also be argued that accountants are professionals with an ethical code of conduct. Consequently, they do not need to have their behavior regulated by detailed and strict rules and regulations. Section 1.3. Auditor independence. It is well established that independence is fundamental to the credibility of the audit process. Much of the current thinking on independence has been developed by the Securities and Exchange Commission in the USA. The work of the SEC has followed on from the corporate scandals in the US in 2001 and 2002, such as Enron and WorldCom. Similar proposals have been put forward in the UK and in other countries. In January 2003, the SEC adopted rules to implement the Sarbanes-Oxley Act 2002 on corporate governance. The rules aim to strengthen auditor independence and require additional disclosures to investors about the services provided to corporations by an independent accountant. The SEC approved the following measures. 1. The rules relating to non-audit services were revised. In cases where the independence of the firm would be impaired if it provided the non-audit services to the audit clients. 2. Rules for the rotation of audit partners. Certain partners on the audit engagement team should be rotated after no more than 5 or 7 consecutive years, depending on the partner's involvement in the audit. However, some small accounting firms may be exempt from this requirement. 3. Establish rules that an accounting firm would not be considered to be independent if certain members of management of the client had been members of the accounting firm's audit engagement team within the 1-year period preceding the commencement of the audit. 4. A firm should not be considered to be independent from an audit client if any audit partner involved in the audit has obtained payment for services relating to engagement with the client for services other than audit, review, and attestation services. 5. The auditors should be required to report certain matters to the client audit committee, including reports on any critical accounting policies that are being used by the client. 6. The audit committee of the client should be required to approve in advance all audit and non-audit services provided to the client by the auditor. 7. There should be disclosure to shareholders of information about audit and non-audit services provided to the client by the auditor and the fees for those services. Section 1.4. The provision of non-audit services to audit clients. Non-audit services that might impair the firm's independence. The Sarbanes-Oxley Act lists 9 non-audit services that are considered to impair the firm's independence if they are provided to an audit client by the firm. These are set out below. 1. Bookkeeping or other services related to the accounting records or financial statements of the audit client. The rules prohibit an accountant from auditing the bookkeeping work performed by his or her accounting firm on behalf of a client. 2. Financial information systems design and implementation. The rules prohibit a firm from providing any service related to the information system of the audit client unless it is reasonable to conclude that the result of these services will not be audited. These rules do not prevent a firm from working on the hardware or software system of an audit client if these are unrelated to client financial statement or accounting records, and provided that the provision of these services by the firm is approved in advance by the audit committee. 3. Appraisal or valuation services, fairness of opinions, or contribution in kind reports. All these activities are essentially services involved. All these activities are essentially services involving a report from an accountancy firm on the valuation used in a transaction. The rules prohibit an accounting firm from providing such services unless the results of these services will not be audited as part of the audit of the financial statements. 4. Actuarial services. The rules prohibit an accounting firm from providing any actuarial advisory services to an audit client that involves a decision about amounts to be recorded in the financial statements of the audit client. Such a service may apply, for example, to the valuation of pension funds, which is connected to the valuation of pension fund liabilities. An accounting firm may, however, assist a client in understanding the methods, models, assumptions, and inputs used in computing an amount. 5. Internal audit outsourcing services. The rules prohibit the accounting firm from providing an internal audit service that has been outsourced by the audit client, where the internal audit work relates to the audit client's internal accounting controls, financial systems, or financial statements. This means that internal audit work relating to operational controls and compliance by accounting firm are permissible. 6. Management functions or human resources. The rules prohibit an accounting firm from: point 1. Acting as a director, officer, or employee of an audit client, or 2. Performing any decision-making, supervisory, or ongoing monitoring function for the audit client. Point 3. The independence of an accounting firm will also be impaired if the firm provides assistance to the audit client in connection with any senior level management appointment. An accountant's independence is impaired with respect to an audit client when the accountant seeks out prospective candidates for managerial, executive, or director position within the client company, or acts as negotiator on the audit client's behalf with any person who has applied for a senior management position, or undertakes reference checks of prospective candidates for a senior management position. Under this rule, an accountant's independence will also be impaired when the accountant engages in psychological testing or other formal testing or evaluation programs, or recommends or advises the audit client to hire a specific candidate for a specific job. 7. Broker or dealer, investment advisors, or investment banking services. Acting as a broker, dealer, promoter, or underwriter on behalf of an audit client will make the accountant an advocate for the audit client and will impair his independence. 8. Legal services. An accounting firm is prohibited from providing to an audit client any service that could be provided only by someone qualified to practice law in the jurisdiction in which the service is provided. 9. Expert services unrelated to the audit. The rules prohibit an accounting firm from providing expert opinions to any audit client for the purpose of advocating that audit client's interest in litigation or in any regulatory or administrative processing or investigation. Advantages and disadvantages of the auditor providing non-audit services. Advantages. The accounting firm is in an excellent position to provide its clients with non-audit services. This is because it already has an extensive knowledge of its client, the client's business, and its systems, and it should therefore be able to provide the additional non-audit services to the client at a lower cost than other accountancy firms and with less disruption to the client. Non-audit work also makes accounting firms more attractive in the recruitment market because a wider range of work experience can be offered to trainees. Disadvantages. However, there are some obvious disadvantages to providing non-audit services. 1. The accounting firm may be seen by the world at large to lack independence from the client because of the large fees it receives for audit and non-audit work. This was a criticism leveled at the hosting office of the accounting firm Andersons following the collapse of Enron. 2. Accountants from the accounting firm may find themselves in a position where they are making management decisions. If so, their independence is impaired. Section 1.5 Audit Rotation. The need for auditor rotation has been a topic of discussion following various major corporate failures in recent years. There has been a general perception that in many cases of corporate collapse, the accounting firm was too close to the audit client and had failed to detect the warning signs of collapse for the client to take appropriate preventative measures. It has therefore been suggested that there should be a regular change in the individuals who perform the audit of a client company. This should prevent the auditor from becoming too familiar with the client and key members of the client staff as a result of developing a long and comfortable relationship. There are two different suggestions about how auditor rotation should be achieved. 1. Audit partner rotation. The accounting firm may remain as auditors of the same client company for an unlimited number of years or until the company decides to change its auditors. However, the lead engagement partner and other key members of the audit team should be rotated regularly. 2. Audit firm rotation. Alternatively, the accounting firm itself should remain as auditor of a client company for no longer than a specific number of years, say 5 years or 7 years. Note that in many countries, including Nigeria, this would require legislative amendments, as the law frequently provides that auditor's appointment is for 1 year, renewable indefinitely. Audit partner rotation has been adopted in most countries. However, audit partner rotation is not visible to the world at large. In contrast, accounting firm rotation would provide a public demonstration of auditor independence. Arguments in favor of accounting firm rotation. There are several arguments in favor of the rotation of firms providing independent audits, including 1. In a long-term audit relationship, the auditors may become too close to management of the client company. This may weaken their professional skepticism and independence. They may be more likely to compromise when disagreements with management occur in order to preserve the relationship and the audit and their fees. Even if rotation would not protect the independence of the accounting firm, it improves the public perception of independence and so may increase confidence in the quality of external audits. Arguments against accounting firm rotation. However, there are also a number of arguments against the rotation of firms providing independent audits, including 1. There may be negative effects on audit quality and effectiveness in the first year following a change. This is because the new auditors may take several years to familiarize themselves with their new client and its procedures. There is some evidence to suggest that there may be a higher instance of audit failure in the first year following a change of auditors. If this evidence is valid, the connection between company's failure and a change of auditors may reflect an inability of the new appointed auditor to identify problems in the client's company. 2. There are also substantial costs from changing auditors regularly, as the auditor attempts to familiarize himself with the new client. More management time is also needed to assist the new auditor to learn about the client's company, its operations, and its systems. 3. There is no evidence that compulsory audit firm rotation has a positive impact on auditor independence and audit quality. The market for auditing listed company is dominated by the Big Four accountancy firm. If this domination of the audit market continues, which is probable, it may be difficult to change auditors easily. The other large firms may not have available resources to take on the audits or may not be independent because of their non-audit services that they already provide. Subsection 2. The Accountancy and Auditing Profession. Section Overview. The current structure of the auditing profession, Incorporation and the problem of auditors' liability. Section 2.1. The current structure of the auditing profession. Because of the increasing globalization of companies, the auditing profession now has 3 tiers. 1. The Big Four international firms, Deloitte, Ernst & Young, KPMG, and PricewaterhouseCoopers, PwC. 2. The second tier, smaller firms but still with numerous offices and international resources. 3. The small firms. The Big Four came about from mergers and takeovers within the profession. They have the resources, expertise, and geographical coverage to be able to audit the largest global entities. However, this level of amalgamation has left little choice for the largest clients and little competition for those large accounting firms. Section 2.2. Incorporation and the problem of auditors' liability. In most countries, accountancy and auditing practices were originally established as sole practitioners or were permitted by local law partnerships. With these business structures, the owner or owners have unlimited liability for the liabilities of the practice. This would include liabilities arising from legal claims against the firm for negligent audit work. The owner's personal assets as well as business assets are at risk if the firm itself cannot pay claims against it. This principle of unlimited liability was intended to promote public confidence in the auditing profession and to encourage auditors to carry out their work with due care. However, problems began to emerge as businesses grew and the size of claims against auditors increased. One response to this was the introduction of requirements for practicing accountants to carry professional indemnity insurance so that liabilities arising from legal claims against a practitioner or partner can be met through an insurance policy. However, the premiums for professional indemnity insurance began to rise as the size of claims increased. This has imposed an increasing financial burden on accountancy firms, particularly on smaller firms. A more recent development for giving financial protection to accountants has been a movement towards removing unlimited liability status of auditors. A number of approaches are available to achieve this. They include the following. 1. Accountancy practices may be permitted by law to trade as limited liability company. 2. Accountancy practices may be permitted by law to trade as limited liability liability partnerships. This is permitted, for example, under UK and Nigerian law. 3. Statute law may place a maximum limit on the size of legal claims against the auditor. 4. The auditor may be able to agree with the audit client a maximum limit on legal claims as a formal term in the written contract under which the audit is performed. Subtopic 3. Transnational audit. Section overview. Definition. Transnational Audit Committee. Section 3.1. Definition. A transnational audit is an audit of financial statements which are or may be relied upon outside the audited entity's home jurisdiction for the purpose of significant lending, investments, or regulatory decisions. This will include audit of all financial statements of companies with listed equities or debt and other public interest companies which attract particular public attention due to their size, products, or services provided. IFAC's Transnational Audit Committee gives the following illustration of transnational audits. Example 1. U.S. company raising debt finance in Canada. This will qualify as a transnational audit as it is reasonable to assume that providers of debt finance in Canada will use the financial statements of the company, prepared and audited by the American standard in making decisions. Example 2. International charity taking donations through various national branches and making grants around the world. This will qualify as a transnational audit as it is operating across national boundaries and is of public interest, being a charity. There is a reasonable expectation that the financial statements of this charity will be used by someone, perhaps donor, in countries other than the one it is domiciled in. As companies subject to transnational audit are generally listed, they will have a large amount of regulation in terms of listing requirements and corporate governance requirements, which the auditors must be aware of. Their listed status may also affect the standards by which their financial statements are prepared and audited. For example, if they are listed on a European stock market, the financial statements will have to be prepared according to international financial reporting standards and audited in accordance with international standards on auditing. Such audits demonstrate the need for harmonized global standards in accounting and auditing. Section 3.2. Transnational Audit Committee. The Transnational Audit Committee is a committee of IFAC. It represents and meets the needs of the forum of firms, which are firms that participate in transnational auditing. Specific responsibility of the TAC include: TAC means Transnational Audit Committee. So specific responsibilities of Transnational Audit Committee includes: 1. Identifying audit practice issues. When the issue suggests changes in auditing or assurance standards may be required. When the issues suggest changes in auditing or assurance standards may be required, recommend to the appropriate IFAC standard setting board that the issues be reviewed. 2. Provide a forum to discuss the best practices in areas including quality control, auditing practices, independence, and training and development. 3. Proposing members to the IFAC regulatory liaison group and identifying qualified candidates to serve on IFAC standard setting boards. 4. Acting as a formal conduit for interaction among transnational firms and international regulators and financial institutions with regards to audit quality system of quality control and transparency of international networks. Subtopic 4. Small companies. Section overview. An audit is an audit. Audit exemption for small companies. The audit of smaller entities. IAASB alert. Applying ISAs proportionately with the size and complexity of an entity. Section 4.1. An audit is an audit. An audit is an audit is a phrase that may be used to argue that the essential features of an audit are the same, regardless of the nature or size of the entity under audit. I repeat, an audit is an audit is a phrase that may be used to argue that the essential features of all audits are the same, regardless of the nature or size of the entity under audit. There is some truth in this view. For example, all audits are regulated by the ISAs, and all audits result in the opinion from the auditor about whether the financial statements give a true and fair view. However, the audit process itself differs significantly between clients, depending on 1. The key characteristics of the client, such as the size of the client and its operations, and 2. The audit strategy adopted by that client. The entity size is a key feature of an entity that has a significant impact on the audit approach. Smaller entities may require a very different audit approach from large entities. Section 4.2. Audit exemption for small companies. Many countries do not require small companies to undergo a statutory annual audit. However, the definition of small companies varies between countries. For example, 1. In the UK legislation currently exempts from audit all companies with annual revenue not exceeding £6.5 million. In the US, only companies listed with the SEC are required to have an annual audit. In Nigeria, it is a requirement from all companies listed in the Nigerian Stock Exchange submit audited financial statements. Furthermore, Section 357 of the Companies and Allied Matters Act 1990 states, every company shall at each annual general meeting appoint an auditor or auditors to audit the financial statements of the company and to hold office from the conclusion of that until the conclusion of the next annual general meeting. There has been much debate surrounding the issue of audit exemption for small entities, although there are currently no immediate plan to introduce exemption in the short term in Nigeria. It is worth noting that small companies which are exempt from the statutory audit requirements may still choose voluntarily to have an audit of their financial statements in order to enjoy the benefits an independent audit may bring. Benefits may include, for example, enhanced credibility when attempting to attract new capital. A number of arguments for and against exemption are presented below. Arguments for audit exemption for small entities. There are various arguments in favor of the view that small companies should have an exemption from statutory external audits. 1. Audit costs are high. The resources could be spent by smaller entities to obtain more useful financial services. 2. Providers of loan finance, for example, banks, will normally attach their own specific conditions to borrowings. These conditions are often independent of the content of the borrower's financial statements. 3. Filing deadlines for the accounts of smaller companies are often long after the reporting date. The audited financial statements are therefore often out of date and of limited use by the time they become available for inspection. 4. Many countries allow smaller companies to publish abbreviated financial statements. Consequently, only a limited amount of audited information is available to users of the statements. Arguments against audit exemption. There are also various arguments against the view that small companies should have an exemption from statutory external audit. Some of these arguments emphasize the potential benefits of annual audit. If these financial statements have been prepared by a part-qualified accountant, an audit provides some assurance that they provide a true and fair view and do not contain material misstatements. 2. The audit is valuable, especially to user groups other than the shareholders, by giving them some reassurance about the financial statements of small entities. 3. Shareholders, especially minority shareholders, should be entitled to receive financial statements from the entity that have been independently audited. 4. The external audit imposes a level of discipline on companies in matters relating to accounting and internal control. The auditors can advise management on ways of improving internal control. 5. The audit may identify areas where efficiency and cost savings can be made by the entity. These savings would have the effect of reducing the overall cost of the audit. 6. If a small company expects to approach its bank in the future to ask for loan finance, the bank may demand to see audited financial statements for the purpose of assessing the loan application. 7. The tax authorities are more likely to accept audited financial statements as a valid basis for computing the company's tax liability. However, in Nigeria, the tax laws have made it clear that the absence of audited financial statements would lead to the use of best of judgment assessments to determine the tax liability of the taxpayer. If the small company expects to grow, it will become large enough at some time in the future to require a statutory annual audit. If there are material errors in the financial statements, the cost of its first statutory audit could be high. Section 4.3. The audit of smaller entities. Standard audit practice requires the auditor to gain an understanding of the business and its environment in developing an audit strategy. Applying this principle to the audit of smaller entities will allow the auditor to focus attention on the main features of the client, which will affect the audit approach. The key issue in deciding the audit approach is likely to be internal control and the limited nature of the control system. 1. Segregation of duties is likely to be weak due to the restricted numbers of staff employed by small employees. 2. Owners or senior management are likely to dominate all major aspects of the business activities. This is useful as a form of supervisory control, but the internal controls over management themselves are likely to be very weak and ineffective. 3. In an expanding business, senior management may be closely involved in developing the business, leaving them with little time for supervisory controls or for implementing and monitoring other controls. 4. Record keeping and documentation of system and controls may be informal and inadequate. This further weakens the internal control system. Audit approach to smaller entities. The table below summarizes the main additional points for the auditor to consider when dealing with a smaller entity. Areas and comments. Area: acceptance of the audit appointment. Comment: the auditor should be aware of the possible risk to independence resulting from close involvement with management. 2. Pressure by management to reduce the audit fee. Area: engagement letter. Comment: this formalizes the relationship between the auditor and the client. If necessary, separates the accounts preparation function from the auditing function. Area: planning and recording. Comment: this process will be similar to the audit engagement for larger entities, but it is likely to be simpler. The audit team may be very small, so communication and coordination should be easier. A brief memorandum prepared at the completion of the previous audit, updated in the current period based on discussion with the owner manager, may be sufficient as the documented audit strategy for the current audit. Accounting systems. The accounting systems may not be adequate for audit purposes, and the auditor may not be able to rely on the control in practice. As a result, control risk is likely to be high. Substantial procedures. Substantial procedures are likely to form the basis of the audit work if controls are weak. However, it is difficult to reach a conclusion on the completeness of accounting records where the audit is based on substantial procedure. Audit evidence. High quality evidence may be more difficult to find than in a large entity. Materiality. A smaller entity's profits before tax may be consistently negligible, as the bulk of any profit may be taken out by the owner manager as remuneration. A benchmark such as profit before remuneration and tax might therefore be more relevant. Analytical procedures. Smaller entities may not have interim or monthly financial statements, which can be used for analytical review purposes. ISA 315 suggests that the auditor may be able to use an early draft of the entity's year-end financial statement. Management representation. These are often more important in smaller entities than large entities. However, the auditor must look for evidence to support the management representation. Going concern. A smaller entity may be more able to quickly respond to opportunities, but it may also be more vulnerable to a bank withdrawing support. The continued financial support of the owner manager may be vital to the survival of the entity, and the auditor will need to assess the risk of that support failing. Audit report. There may be insufficient evidence as to the completeness and accuracy of the records, which may lead to a qualified audit opinion. Review of financial statement. This is the same as for the audits of any other company, except that smaller entities may be exempt from certain reporting requirements, for example, from the application of certain requirements of International Financial Reporting Standards, IAASB alert. Applying ISAs proportionately with the size and complexity of an entity. In August 2009, the IAASB issued a question and answer publication to highlight how the design of the international standards on auditing issued by the IAASB under the Clarity project enables them to be applied in a manner proportionate with the size and complexity of an entity. Specifically, while ISAs apply to audits of entities of all sizes and complexities, the question and answer focuses on matters that are likely to be of particular relevance to their application in the context of an audit of a small and medium-sized entity, SME. The key point includes: Point 1. The auditor's objectives are the same for audits of entities of different sizes and complexities. This, however, does not mean that every audit will be planned and performed in exactly the same way. The ISAs recognize that the specific audit procedures to be undertaken to achieve the auditor's objective and to comply with the requirements of the ISAs may vary considerably depending on whether the entity being audited is large or small and whether it is complex or relatively simple. The requirements of the ISAs, therefore, focus on matters that the auditors need to address in an audit and do not ordinarily detail the specific procedures that the auditor should perform. Point 2. Often, SMEs engage in relatively simple business transactions. This means that their audits under the ISAs will generally be relatively straightforward. The alert offers a number of illustrations. The typical simpler structure and processes in an SME often mean that the auditor may obtain an understanding of the entity and its environment in accordance with ISA 315 quite readily and documents this in a straightforward manner. Similarly, internal control in the context of an SME may be simpler. Point 3. The ISAs help guide the auditor in their application to an SME audit by specifying alternative procedures regarding understanding the entity's risk assessment process when the entity has not established such a process, specifying a choice of audit procedures based on the particular circumstances, e.g., choice of responses to assessed risk for accounting estimates such as ISA 540. They indicate if a requirement is conditional, where those charged with governance and management are the same. Individual ISAs also include useful guidance that assist the auditor in understanding or applying specific requirements in the ISAs in the context of an SME audit. Point 4. The auditor shall comply with all ISAs relevant to the audit. However, for an SME audit, several of the ISAs may not. For an SME audit, several of the ISAs may not be relevant as the circumstances in which the ISA applies may not exist in the engagement. For example, ISA 402, if the SME does not use a service organization. ISA 510, if the SME audit is continuing and not an initial engagement. ISA 600, if the SME audit engagement is not a group audit. ISA 610, if the SME has no internal audit function. ISAs 800, 805, 810, if the SME audit engagement is to report on general purpose financial statements. Even if an ISA is relevant, not all of its requirements may be relevant. E.g., holding an engagement team discussion if it is only a one-person team. Performing specified substantial and other follow-up procedures. If the auditor has not identified previously unidentified or undisclosed related parties or significant related parties transaction. Audit documentation assists the auditor in an SME audit, e.g., assists in planning and performing the audit, provides a record of matters of continuing relevance, enhances the quality of the auditor's judgment. The ISAs recognize it is unrealistic to expect every aspect of an audit to be documented, e.g., documenting compliance with matters for which compliance is demonstrated by documents included within the audit file, e.g., an audit plan demonstrates the audit was planned.